We got a special guest on today's show. You are not Malcolm Etheridge. You are Matt Argersinger. Former senior equity analyst at the Motley Fool. But now he is on This Time Is Different. I haven't seen you in like a year, man. How are you? Podcasts are just an excuse to catch up with old friends, by the way. So I want to hear about how you're doing.
That's right. Well, I'm following in your footsteps, Ricky. Left the old place just recently. And, I'm enjoying being kind of a full-time dad, at least the last couple months. And that's been good for me. I should probably update my LinkedIn, though, because right now my LinkedIn literally says full-time dad. And it should be like, what do hedge fund investors do when they leave their hedge fund? They run family offices. So I should be like the CIO of my family office. Family office CIO.
Well, I think are you trying to get another job right this second? Because then it doesn't matter what your LinkedIn is. That's Otherwise, right. You might want to, independent investor running a family office, real estate guru.
Those are all very flattering, none of which I am. But yes, maybe if I was actually looking for a job at the moment, I would go that route.
So then my advice would just be get off LinkedIn. What are you doing on
LinkedIn? Probably a good idea, but I feel like I had to do something because I've been on LinkedIn for so many years and got to leave something there for people. But no, it's been good. The one thing that happened also besides leaving the job was we sold our last rental property in DC. I'm still in Virginia. And so that was like a big milestone, kind of exiting that real estate part of our life, and also resulted in getting a lot of cash. So financially, things are pretty good right now. That might have to change at some point, but it's all good.
But you're out of the real estate landlord game.
I am out of the landlord game, and it feels great.
Usually people get more into, I feel like when I hear people getting into it, they get one rental property and then they're trying to go for like 20,000 apartment units for syndication deals.
That's right. That's the natural evolution of things. But you find out after the second or third rental property how much of a pain it is. And, and you want to pull your hair out some nights. Okay. So I'm done doing that for now.
Sweet. So rest of the show, the actual show. Outside of what's happening in Matt's personal life, which I've been curious about as a colleague. We used to podcast all the time.
Yeah, man.
I've done some reporting on this like Trump organization lawsuit against Capital One. Not like a lawsuit, it is a lawsuit. And I've been exploring just the topic of debanking lately. So I may just talk at Matt about some journalism I did. We'll see. And then honestly, one of the big themes, if you've been listening to this show for a while now, is Malcolm and I have been talking about just how there are looking for places to hide. And Malcolm said it on a previous episode of just, it seems like everyone is saying that basically everything's cheery in the stock market right now. And I'm starting to get early 2022-ish vibes when everything was really opening back up with COVID. And that's something I've been focused on. And then I may still bounce some income type investments, some real estate REITs off the master himself. So let's get into it.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
We will get to the stock stuff, I promise. But first, I had this story come out for The Indicator. You can find the full episode. It's on Capital One versus Trump. And the context of what happened is in the months that followed January 6th, a few banks went to the Trump organization and said, we don't want your business anymore. And didn't really give an explanation why. And so it's a few months after January 6th riots. So the belief is, okay, that played a role and this was a political debanking. But they didn't quite give that reason. They didn't say, we think you're a yucky customer, we're out. And so now that there's been sort of a tour de force of Trump suing private companies, and sometimes he's making billions of dollars doing so because they just want to settle and get it over with. Capital One kind of bit back in an interesting way, which is that they said, no, it's not January 6th. We found, we have anti-money laundering concerns about those accounts, which is why we shut them down, which is a very different issue. So I think just looking at this, I had a question, which was just like, is this like a late foul call on the side of Capital One? Why wouldn't they just come out and say it earlier, which is, hey, we found some suspicious transactions in your bank. We're not saying you're doing anything illegal, but we just don't want your business anymore. And is there legitimacy to the political debanking story? Because that's something people hear a lot in the news. And so I would say, one, there is political debanking. It's well documented and a huge problem. And it is unusual for a bank to come out and say, we're shutting down your account for anti-money laundering concerns afterward, right? Like usually it's just like, nope, we're shutting down your account. That's a part of our customer agreement. Anyway, I will stop there, Matt. If there are things on debanking or this story that you think are interesting or want to talk about.
It's very interesting, and I thought you did a great job, Ricky. There are a couple things that make me uncomfortable about this. I am uncomfortable with the idea that you can be debanked on political grounds, that the organization, the corporation, for whatever reason, just doesn't like the business you're in, doesn't like the political stink around it, and they can just debank you. I'm also a little bit uncomfortable with the idea that the bank could just shutter your account for really and give you no reason. At the same time, though, this is where I hold two minds on this, though. Banks are really good, especially an organization like Capital One, who has done, you point this out, billions of transactions, millions of customers over many decades. I'm guessing their spidey sense is pretty good when it comes to things like fraud or money laundering, other illegal activities. I'm guessing there's some smoke here and certainly a little bit of fire. So yeah, if there's illegal activity going on, hell yeah, the bank should stop doing business with this customer. And maybe they don't have to give a reason. And maybe they didn't give a reason at the beginning just to, spare the Trump organization a little flack. Hey, we're just keeping this out of the headlines. We just want to end the relationship. We don't want to make a big stink about this. So yeah, two minds around this. I thought you did a great job. I don't like the political angles, but I do like the idea that, hey, as soon as there's any smoke around illegal activity, cut it off.
Yeah, and I understand why a bank would not come out and say, hey, we found some suspicious activity. If you're running an investigation, you don't want to
tip off the criminal to like, hey.
Exactly. And I was totally unaware of this story. And it's something where, like, back in 2013, banks were shutting down accounts totally in one industry where it was, I think it was like payday lending, pawn shops. There was some like sex related products that they're like, this stuff is yucky. And so they started lumping it in with actual fraud for banks to shut it down. And then you sort of have this ski slope down to what my source, Brian Brooks, who's a former banking regulator under Trump 1, saying he's just on the phone with climate change activists saying you shouldn't provide payroll for an oil company. And that's where the danger lies. And the two questions I have kind of going forward on this are, number one is a smaller question, which is, did Capital One do this as a threat versus just like, hey, we have the right to shut you down? Are they making a direct threat, which is, we're going to start, if it doesn't violate the Bank Secrecy Act, which I'm not an expert on, are we going to start opening the books even more, which could be embarrassing for you? And then number two, just like, is this the other ripple of, we see things move hard to the left, we see things move hard to the right, and now I think we're going to get that swing back of seeing things in America moving hard to the left. And You're seeing that with, the rumblings of debanking, which had been there. That's a reminder that it has been there. And then you're also seeing, more left-wing extreme political candidates on the left starting to get in office.
I hope that's not the case, by the way. I hope it's not this. We have these, depending on who's in power or what the political leanings of the country happen to be at any time, banks are sort of shifting how they do business.
I would say you're a more cautious cat among the investors I've spoken to. you are optimistic, but you look at historical trends and think about how things could potentially go wrong. We're still in a euphoric market right now. I'm seeing data. It's like over the past year, more Americans are becoming less confident about their retirement. Fewer Americans are confident about their retirement is a cleaner way of saying that. At the same time, you're seeing markets rocking at all-time highs. The memory trade, a little hot in the streets again. And just like now that I've noticed my views on the market changed a little bit once I stepped back from the like daily looking at stocks, analyzing stocks all day role. But now that you've taken a breath, you're enjoying your time a little bit. Where are you at on the market right now, man? Like, I know it's a weird top-down question, but just like your macro view of what you're seeing going on, and maybe we'll start there and then ask follow-up questions.
Sure. Well, I think I'm kind of where you and Malcolm are, in the sense that there is I don't know, call it a level of complacency when it comes to the market, that things that have been working are going to continue working. I mean, one of those main things being this AI trade that looks ever more perilous to me. But no, I mean, I think overall, Ricky, there has just been this, I don't know, this shrinkage in the idea that of getting a return on my investment. You know, for years it was, hey, buy a quality stock, hold that stock for 5+ years, make a great return. You buy enough of those stocks, you do incredibly well over time. And I'm pretty sure that's where you and Malcolm land as well, most of the time. But then there's this layer in the market, and it certainly is. You did some great work on this last episode. There is this, especially among the Gen Z types, which you kind of fall into, my man, where there is this little bit of gambling mentality. It's like, you know, my job is not certain. Hell, AI might take my job in a month. I've got some cash. I need to make that work for me now. I need to put this, and I need to make 10x on this in a year, or I'm not going to pay rent or buy groceries in a year. So it's like you get this, you know, like sports gambling, prediction market stuff. You get 0-day options, which have exploded, which is a whole nother crazy thing. Leveraged single stock ETFs, which have exploded, which is insane to me. I call them like the degen investments out there, but they're all part of people's portfolio now. It's not just, oh, I've got a little crypto, I do a little options on the side. I've got some, some, maybe even some venture capital. No, it is like 50% of my portfolio is like crypto, sports gambling, prediction markets. I mean, maybe in 2021 it was NFTs, but it's just the question of what could go wrong with these, or what could go wrong with any of my investments is not really being asked right now. And so, and you point out the historic level of trading of margin, which you guys discussed as well, which is, so I guess, but underpinning all of it, I think all of this is that the idea that the music playing around this AI game of musical chairs, it's never going to stop playing. So everyone just keeps dancing. You know, these massive companies are going to keep spending at rates unheard of in the history of capitalism. And that's somehow going to continue indefinitely because the demand for AI is insatiable. And I just think at some point this game of musical chairs, the music's going to stop playing. And I am perfectly willing, as a cautious cat, as you called me, I am perfectly willing to take a seat or leave the party very early.
Oh man, how does it feel to be an AI bear? You're like the only.
I mean, I would say I love AI. I mean, I think you do too.
I do too.
From a consumer point of view, man, it is awesome. But I have a lot of questions about how, you know, Anthropic, ChatGPT, OpenAI, I should say, are going to make money in the long run. I'm very curious as to how the billions, the tens of billions, the hundreds of billions of dollars that are being spent, what kind of return there's going to be on that. I have a lot of questions. And, sometimes like those questions, I don't have good answers to them. I'd rather sit out.
Yeah. And I think that one of the things I have noticed since sort of stepping back, I'm still obviously like watching the markets and looking into stocks, but taking maybe a half step back in some ways is useful. In some ways it's not useful because you lose your network of people talking about great ideas and things they're looking into, but you're breathing more and you're looking into it less. And so what I would say is that I have noticed like there's almost less complexity to some of my like investment theses now, but it's more just like very general and things I feel solid about. And it's that Jason Moser thing of, try to be directionally correct, not exactly right.
Yeah, that's great.
And I feel myself following that a little bit more. And yeah, man, like the combo of margin and leveraged single stock ETFs, which is the responsibility of the SEC. Margin requirements are the responsibility of the Federal Reserve and actually FINRA. FINRA does maintenance margin, but no one cares about that rule because the banks are way past it.
Right.
But who is it? On the leveraged single stock ETFs, which is we're going to throw some instruments inside of an investment so you can 2x or even 3x your Tesla trade or your Micron trade. We saw what happened in South Korea. We've talked about that on the show. Market crash, hundreds of accounts get blown up, hundreds of thousands of accounts get blown up. Most of that's young people. And it was Urian Timmer, who's the director of global macro at Fidelity. He called the levered single stock ETFs weapons of self-destruction.
Absolutely.
And I thought that was a pretty good line. Okay, so we're cautious. We're taking a seat at the party. I understand. With this too, you're an income guy. As we talk right now, we're talking on the week of August 20th. 30-year yield for the US Treasury is at 5.3%, which is the highest it's been. When we first started working together in the early 2020s, what was it, like 2%? You're getting 2% for your money if you wanted to park it with a US bond.
A long-term bond. Short-term bonds were less than 1%.
Yeah. And even with like a big tech company, you're still getting less than 3% to lend money to a private company, or you can throw mortgages in there as well. The spread on this debt too, something I've discussed, is about 1%, where a long-term bond for Amazon is paying like 6.3% for US government debt, 5.3% for US federal debt, And you're also seeing the AI trade play in here, which is that with all these huge data centers being built out, that's starting to compete for the income bond dollars. Is, do you want to buy an Amazon bond or do you want to buy a US federal government bond? More investors are sort of weighing those for income, but I don't know. I think, you can sound the alarm bell, hit the panic button, which I don't like to do, but it's a good question frame with the bond market being this high. But as a income guy, what are you seeing here?
Well, it's an extraordinary time. In some ways it's not extraordinary. And in some ways bonds are almost back to where they've been historically, sort of outside the post-GFC, ZERP world that we lived in for so long, where, Fed rate was effectively zero and bonds were so low. So we're kind of back to normal in a way, but I think it's startling certainly for someone like you, Ricky, who, your investment career is not as long as mine. I'm about to date myself here, but I do remember when, the long-term 30-year treasury was 6% in the late 90s. And there are old timers out there like 6%, dude. I remember when it was 15% back in the early 80s, late 70s, early 80s. So, but it is a different world now. And what's extraordinary to me is that the idea that these spreads, like you mentioned, are so tight. And so I'm taking an extraordinary amount of risk. And by the way, paying more taxes as well to buy, say, a high grade corporate bond when I can get a long-term treasury for just a little bit less yield. And I have to believe that's going to start playing a role, right? That the opportunity cost in the market is effectively always comes down to the risk-free rate. And if the risk-free rate continues to head higher, as we've seen, why in the world am I investing in, other types of bonds, even junk-rated bonds, which the spread isn't wide either, or even taking risk in equities, right? I mean, I'm always going to be invested in equities, but at some point you have to ask questions there as well. And so I don't know. This all plays into this idea that the riskless, well, quote riskless, if I believe in the U.S. government's going to cover its debts, which it has for 250 years. That's going to become more and more appealing to me, especially for older investors. Now, the Gen Z trade is still going to be going on because 6% isn't enough for the D-Gen crowd. So,
no, it's not.
But it has to start playing a role, and there's no reason these yields can't continue to go higher.
So that is one decision that I have been thinking about with this news is I own an ETF of high yield corporate bonds. It's USHY, US high yield debt. I think might be an iShares thing. And as I'm looking at this, I'm like, is this like a 2% ish spread for like junky corporate bonds where yes, it's diversified. Like there's some defaults in there, but it's also something it's like, I think if not 1,000, like hundreds of different hundreds of stuff in there. So I don't want to totally analyze it, but if you're not giving me a big spread on that, maybe I'll go figure something else out.
Yeah.
Anyway, the one question I wanted to ask you, I made a share about how sort of leaving the world of looking and analyzing stocks every single day is a full-time job. I look at stocks every day, but I'm not doing it as a full-time job. How's that affect you? How has that affected how you personally invest and think about money? Yeah,
it's affected it. I mean, so if I take that top-down view that I just kind of shared and a little bit of pessimism about this sort of AI-driven market and economy that we're in, and then I also add in the fact that, hey, I'm not working right now. I'm between jobs, let's say. Just sold a property, so I've got some capital. Got a 7-year-old son, so again, naturally, I'm a little more conservative than I was when I was 25. So if you look at sort of my main portfolio and how it's broken down right now, it's the ultimate old man portfolio. So I've got about 30% in cash and ultra short-term bonds. And so when I say short-term bonds, I'm looking at short-term treasury, like 1 year, 2 year less maturity treasury bonds and high-grade corporate bonds. I've got about 25% in large cap dividend payers. Your Home Depots of the world, your Chevrons of the world, ConocoPhillips is in there. Then I've got 25% in real estate investment trusts. I can't quit REITs. You and I have talked about REITs for years. I'm a huge fan of REITs. I still think there's tons of value in there, and we can talk about that. And then I'd say 10% is in a kind of a relatively new asset class for me, which is preferred equity. And I've gotten really attracted to this space. I've spent some time this year kind of digging in and researching it. And I think there's a lot of value there for investors too, especially if rates go higher. I mean, with preferred equity, and many companies, hundreds of companies issue preferred equity that's publicly traded. You can get 6 to 7, even 8% yields that are pretty safe from companies that are paying common dividends, because preferred dividends have to be paid first before common dividends get paid. If there's a liquidation, preferred equity has to get paid out first. There's some advantages. It's sort of like a hybrid dividend stock and a hybrid debt offering, which is really attractive to me. And yeah, I've got 10% in what I'd call, just like you, like sort of actively managed bond credit funds. And what's interesting about the bond space, especially, and I hope I'm not losing your audience who might be really equity focused, but in the bond space, we're used to passive equity funds crushing active. We've seen that, right? Something like 90% of actively managed equity and fund managers lose to the market or lose to their benchmark over time. It's actually the opposite in the bond market. It's fascinating. Actively managed bond managers actually outperform their benchmarks by quite a interesting margin. So if you're interested in bonds, I would certainly go the diversified fund route. I'd certainly go the active management route. And you can probably find a lot of alpha within that space and do quite well. Get yourself, a good mid to high single digit yield with some capital, little bit of capital appreciation as well. So all this to say is, yes, very cautious. But layer the fact in that I also have a family that I'm taking care of, some capital I'm trying to preserve. So there's some personal reasons why I'm a little bit more cautious as well.
And to be clear to any listener who didn't tune out on the credit or the preferred equity advice.
Are you still there?
Yeah, you're still there. If you're tuning out, email us at thistimepod@gmail.com. You can let us know. No, I think this is a point well taken. The disadvantage, or actually the point I was going to make, Matt is not offering investment advice. He's telling me, a friend, what he is personally doing with his money as we speak as friends in this very private manner.
That's right.
That doesn't necessarily mean you should follow it because you're probably in a different position. I'll also note that you didn't include comic books into that bucket, which I consider an asset class, by the way. If you're collecting rare comic books, that's something or can be pretty confident it will at least hold. I'm seeing Action Comics behind you. I'm pretty confident.
Yeah.
I'm pretty confident that'll hold its value over the next 10 to 50 years.
I'm a believer there.
I want to get back. We can get back to the actively managed things in a sec. I'm also stewing on this larger long-term economic theory as I'm a borderline Gen Z millennial, which I define as remembering life without a smartphone. And I do remember life without a smartphone. So I consider myself borderline millennial.
That makes me feel so good that you actually remember life without a smartphone, Ricky.
That also means I like, yeah. Anyway, I was going to make a joke I shouldn't make. I'm also thinking about this like economic theory that I've been stewing on, because there are things that we have taken for granted in the United States, in America, in my lifetime, that I wonder if they will no longer be true by the time I'm your age, by the time I'm even retired, which is that in the post-World War II era, most of everyone who's alive's lifetimes, is that the US was just this, not only a dominant force, but just the preeminent world power. I think it's enjoyed that from about World War II to nowish. One of the things we're learning, not just from us, but you can't just like go to war anymore. There are more global players that are taking up this space. It's not just the US as the dominant world force. I don't know if we get back to that. And it's something where I don't know if I let it infect my investing brain. I know it has a little bit. I think that's one reason I have an allocation to gold, which I can talk about. And it's also a reason that I'm starting to think more of what are the best companies that are outside the United States that I can have some shares of. So I'm not just in one single market. That's not to say I'm a bear on the US economy. Most of my investments are still within the borders of the United States. But anyway, it's just like, is that something you are thinking about, or is it even worth thinking about these, cerebral, big brain 10, 20-year macro trends?
No, it's a very interesting view, Ricky, and I'm glad you're thinking about it, because I have thought about it. And I guess maybe to keep it on the markets and not get to the US power dynamics around the world, but I do think the incredible stock market returns that we've had in the US, I mean, not just the last 20 years since the GFC, but I mean, just, looking back into actually since World War II, I mean, just the incredible returns that we've seen in this market. The fact that you can put money to work in a basket of US stocks and be reasonably confident to earn 10% plus total returns every year in and out for going on, 80, 90 years now at this point. I think those days, unfortunately, might be over. I think you do have to look outside the US, especially if you want to achieve those sort of outsized returns that we become accustomed to here. And so, and even some of the big investment banks have put out, models out there that suggest that, I think Goldman Sachs had one recently, but the next 5 years or 10 years for the stock market, US stock market, it's like low single digit returns. And so, one thing I've done just personally, not investment advice, with some of our retirement accounts, because I am thinking very long-term about those, as you mentioned, sort of 10 to 20 years. I have added a few actively managed international ETFs to those funds. Mostly with our retirement accounts, I keep them mostly index or ETF based. And so and Meb Faber, you should definitely have on the show at some point, from Cambria Funds. He's done some really great research looking at international stocks, and especially international stocks with high shareholder yields. So high dividend yields plus high share buyback yields, which the latter part, share buybacks, has not been as popular outside the US as it is in the US, but it's becoming a bigger part of corporate capital allocation in places like Europe and Asia. And so he's identified a lot of companies that have high shareholder yields outside the US, and he's kind of built some ETFs around that strategy, which I like. So I've kind of looked there as well. But I love the idea of, hey, maybe I don't have to give up on the US, but hey, 20, 30% maybe of my portfolio should be allocated outside the US. I mean non-US. I mean, companies headquartered that do most of their business outside the US is not a bad thing at all.
Yeah. Okay. We're on the same page. This might be bad podcasting. I feel like we just like keep generally agreeing with each other. We need to get like Tom Lee on here, someone who's just really really
unabashedly bullish.
AI. Yeah, someone that's going to tell us we're idiots.
Probably doesn't buy comic books either, so there you go.
Maybe. I don't know. Comic books, I feel like comic books are kind of back.
Yeah, they are back a little bit.
More people I'm talking to are interested in comic books. Right. And not just like from the collecting angle. Like I was talking to a guy a few days ago. He's like, I love going every Wednesday to my local comic book shop to
the LCS.
Pick up going to the LCS to pick up some new titles.
Nice.
I'm like, good on you. I think I hear you on actively managed funds. I think finding some top dogs in other markets to the extent you can. This is something, don't think about it too hard. They're expensive. So it's like I've picked up a little bit, I will say, of Mercado Libre, which is allegedly the Amazon of South and Central America. they've gotten beat up lately because people don't like what's going on with their payments platform in the immediate term. It may or may not be like Amazon in 2003 saying we're also launching a credit card for our book business to keep you totally within our platform. And it's something where I have accepted that I am not an expert on Brazilian and Central American credit quality, but the operators there may know more than me and the people on X. So that's one reason I've been picking it up there, is just also looking at some of the basic cash flow metrics.
Yeah, I can't argue with that. Mercado Libre has been a part of my portfolio for 10 plus years now, at least. And allegedly the Amazon of I guess I still believe that they're definitely taking a little bit of a different route. But as a e-commerce leader within, one probably the fastest, most important growing market, at least in this hemisphere, I'd say that's a pretty good bet.
So I will also make the quick case for gold in this bucket as well, which I've made to Malcolm many times. If you're rolling your eyes, I'm sorry. But I do think gold belongs in this basket for a fairly simple reason. Because that's right. Gold bug is an ultimate like old man type of.
Yeah, I'd say you're going more old man than I have on this podcast right now.
All right. So if you're a central bank, if you're an international central bank, have U.S. Treasuries become more risky? Not like not risky, but like have U.S. Treasuries become more risky? That's
such an interesting angle, because I thought you were going to go through this sort of traditional, like it's a store of value, it's an inflation hedge, all this stuff. But you're actually going at it from a tactical, like the central banks around the world may not be as comfortable holding as much treasuries as they have. And so therefore gold is the next best substitute. And you've certainly seen that in the data.
Yeah.
That is interesting. I haven't spent a lot of time thinking about that, but you've already made a very strong case in about 10 seconds. So I love that.
Is a store of value. I've gone more into it on other shows, but I'll stop there. It's also one where you can keep it pretty boring and pretty surface level with that. But I think the same way you're thinking about comic books, in addition to holding cash flowing investments, it is like I'm thinking, what are things that can hold their value for the next 10 to 50 years? And I think it fits in that bucket. And then also real estate and the dividend payers you love so dearly, which is what are companies with big physical assets that pay income to their old men and old women shareholders that want to see that dividend check come in every quarter.
Yeah, absolutely. I mean, I love the idea of real assets earning real cash flows and around the world. And, I've talked about Prologis before as an example. Now it's a US REIT, but it's the largest kind of worldwide owner of warehouses, distribution centers. But the nice thing is with Prologis, ticker PLD, you get a lot of exposure outside the US as well. They just made a big, I think it was like $11 billion acquisition in the UK. But they've got large assets in, Europe, Asia, around the world, Latin America, through some affiliates in Mexico. And so you get to play sort of the world of commerce in a real asset cash flowing type of way. And they've got a great dividend growth track record. And so that's another way, even though it's a US based company, you can kind of play this kind of multi-theme of real assets plus international exposure with that company.
It is also hovering near all-time highs.
It's not cheap. I wouldn't say. I mean, it's not something I want to sell, but you're right. It's definitely not a cheap stock.
It was, and it was cheaper like a year or two ago, which is when I'm holding it as well. But that's like when it was more interesting, is people were like, I'm out on Prologis, which
at a 5% yield almost, and like a 15% FFO, and now it's now everyone knows Prologis.
I don't know if you understand what. Yeah, it's like I don't know why so that's something I like to look for too. It's like, what are these big solid companies that have a little bit of a narrative problem? The other one we've talked about, just to keep listing, is Netflix. That's something Malcolm is about, and some of the software trade, some of the software as a services trade, which he's more knowledgeable than I am on. So I will move to this other income thing that I really want to get your take on. I haven't had a lot of people to talk about this with. It's called GEPQ. It's JP Morgan's NASDAQ covered call ETF, which is, in my spot, you basically pay an investment manager, and then they go into some of those like psycho volatile stocks to buy the stock and then sell calls on it, collect the income premium, and then give that distribution back to the shareholders. And this thing's on fire. So it's like, you look at the chart of income type investments, US equities pay a 1.2% dividend. Bond funds are between 4 and 6-ish, 6.67 for high yield. And then this thing is like 13 to 15% yield on selling these covered calls. And you're in the market a little bit, but it's also, hiring computer people to play with fire is kind of the thesis there.
Yeah, I think it's like JEPQ, they got JEPI, which I think is the S&P 500 version of it. Yeah, these have been on fire. And I think this has been a decent year, a type of year for covered call ETFs like these. You had lots of volatility especially within that technology space. And so they've probably been getting great premiums and also, benefiting from this volatility. And so where these don't work, and I think this, is if we have kind of a runaway bull market, right? If you look at, for example, JEPQ or JEPI from say 2023 to 2025, I'm going to bet, I haven't looked at the chart, but I'm going to bet it's underperformed pretty sharply. And that'll happen to these in periods like that, because generally they're selling the calls against the index and they're getting called away on that. And they're not taking advantage of the full rise of the index over that period. But these can definitely work. I would say if it's a flat, volatile market, this year hasn't been that flat, but it's been pretty volatile. I'd say these can work really well. I actually also own a covered call ETF. It's the T. Rowe Price. See, this is the old man version of this covered call. Okay. It's the T. Rowe Price Capital Appreciation Premium Income ETF. TCAL is the ticker. I like the reason I kind of gravitated towards that one is because JEPQ kind of tends to mirror the index a little bit, like the NASDAQ 100. TCAL takes like a more bottoms up approach. So they have a lot of healthcare, for example. I think they have some energy. So it's very sort of anti-market correlation. But they're also selling covered calls. And so it hasn't done as well as JEPQ. So I'm definitely behind you on that. But I see value in these, especially like if you thought, say, the next few years are going to be pretty muted for stock market returns and pretty volatile, I'd say these can outperform.
Or, to your point, it could be a hedge. Like maybe I'm not thinking about it from the sense of outperforming, but If it doesn't outperform, this is a hedge for exactly the scenario you're describing, which is a flat to slightly down market over the next couple of years.
Yeah.
So what is it? If the market goes up a little bit, it underperforms and the stocks get called away. Okay.
Yeah,
so exactly. It's not losing a ton of money. It's not ideal. And then in a flat or volatile market, it's still collecting the income on those covered calls. So you pay with performance. It's like an annuity scenario. You pay with performance, but you have a little bit of insurance. So that's kind of how I'm thinking about that too. One thing I wanted to go through is since we are more into the real estate game as a place to hide from the AI trade, which I still have investments in, but this is diversification, way more boring. I have been picking up more REITs lately. And I would say I have a few on here. We talked Prologis. I have Americold, which is a cold storage REIT that got absolutely taken to the woodshed. And I think they had like some oversupply problems, but still it's a pretty healthy dividend and seems like it's one of those it's like a utility stock that I thought had the potential to do a little bit better. And it's performed a little bit more lately. Cousins, which is Class A office space. And then the one that I would say I'm most interested in is Vici Properties, which is the landlord of the Las Vegas Strip. If you want to look at the technicals, which aren't super trustworthy, this thing trades within a really tight range. And it just seems unlikely that its tenants of like Caesars and MGM are going to stop paying rent because there's a little bit of a traffic decline, but they make all their money from whales coming in and playing $1 million hands of blackjack.
I'm with you on Vici. I've owned that for a while as well. People can talk about the Las Vegas problem, which I don't think that really exists, and other issues. But the problem with Vici, I think as well, it's a little bit of an interest rate play. So the net lease REIT, net lease REIT, but very long term, like 10 to 20 year leases with major blue chip tenants, right?
Let's explain net lease rate real quick too, though, which is
So Vici is net lease REIT, which means that it owns the building and the land generally, but the tenants are essentially responsible for all the costs, including things like even taxes and insurance. So Vici is literally just the landlord, and an operator like MGM is operating the casino, paying the insurance, paying taxes, paying utilities, paying all the costs related to the property, and Vinci's just collecting rent checks. So it's very clean. It's how a lot of REITs are structured, like Realty Income, ticker symbol O, which is a very popular net lease REIT that a lot of people probably know about or own if they invest in REITs. So it's a very low risk type of REIT, but at the same time, it also can be pretty sensitive to interest rates, because as interest rates rise, and we talked about Treasury yields being, 17-year highs right now, almost 20-year highs. They look at Vici even with its 6% yield, and they're like, it's very stable. I get that, but if I can get a 5% long-term bond or a 5.5-6% high-grade corporate bond, it's a little bit competitive with Vici, which is going to have a little more risk than those. So, but I love Vici. I think it's trading at an extraordinary value right now. Just throw that out there.
There you go. That's one. If you made it 40 minutes in, you got a good one, hopefully, from Matt. But that's the cost of admission. You got to wait 40 minutes. And you did bring this up earlier, like when do you pay a manager for an actively managed fund? Because there is, I think, a blanket belief like, oh, active managers can't outperform, full stop. And there were even some articles of like, look at how poorly, and this is from Morningstar data, look at how poorly large cap stock pickers have done. It was like 27% over a year. And then I think it's like close to 10-ish% over a 10-year period. But then they don't look through it's like they didn't look through the rest of the list, which you have to put your email in for. And to your point, if you're paying a low fee for US real estate, yeah, that could outperform over the long term. Diversified emerging markets, those are doing pretty well. And then to your point, credit, intermediate core bonds, those outperform if you're not paying a ton of money for it. And so what I think is interesting with this theme of when do you pay an active manager, it's when are you paying someone to avoid specific things versus pick winners. And I think that may be a key trend to what you're describing of, I don't want to look at Class B office buildings that are in, different parts of the country. But if someone's doing that for their job, they may be able to avoid some losers.
Yeah, they might have a little more knowledge than I do. No, totally. I love how you're coming from that perspective, which is like, I need to protect myself from things I don't know about this asset class or the risks I'm not aware of, or preventing myself also from taking the amount of time it's going to take to dig into a lot of these different holdings. I don't have time for that, but I want exposure. That's when I pay up, and I don't mind paying up.
All right. We're starting to get till the end here. And since I know you're a superhero and I know you're a comic book fan, this is personal. So if you wanted all the stock stuff, you got about 35 minutes of hardcore stock talk. We try to mix it up on this show. I want to know if, I have started reading Absolute Batman lately. It's available on Hoopla with your public library. Every person I talk to so far who's interested in comics is like, this is the one series you got to check out. I know you're a Batman fan. It's absolutely lights out. Phenomenal. Have you checked out this series yet? Number one.
I have not. Okay. What a fail, right? So
not a fail.
No, it is, because I've heard tremendous things about it. I mean, the books look incredible, by the way. And by the way, from a collecting point of view, I mean, have you seen some of the prices for some of the variants out there on some of these books?
It's like $300-$400 for a new DC comic.
One that came out like 6 months ago. If you find a variant of it, and it's 9.8 CG. Oh, we're totally getting nerdy out here now, but a high grade version of that book.
There you go.
Hundreds of dollars.
No decibels. No decibels.
Well, you're gonna laugh at this, but since I'm, again, being a full-time dad, I haven't had a ton of time just to sit back and read comics. But one thing I have done with my son, which we absolutely love, is we've gone back and watched a lot of the Batman the Animated Series on HBO from the early 90s. I remember watching those when I was a kid, but now I am enjoying them even more, I think, as a dad, watching them with my son, because some of the episodes are incredible. Like, they're really well done. And, so we're working our way through those. And I heard, or I think this is not true, that there's the new Nightfall animated series is coming out, or it's already out maybe, which is, goes through the Batman's Bane, the battle with Bane, him breaking his back, and Azrael taking over as Batman for a while. Gosh, we're nerding out big time here, but that I'm actually looking forward to watching that. as well.
That's why I'm doing it at the end of the show. It's something I wanted to talk about. I mean, the thing with Batman the Animated Series is you just can't make them like that anymore.
No,
because it's hand painted. I get it. It's a pretty brutal process to put together a 25 minute beautifully Art Deco hand painted animated shows.
Film noir type with great classical music and just great action. And I mean, it's just I can't see them making these types of shows anymore. And
it's the kind of thing where well, first of all, it's not profitable, and it's like has this right. That's number one. The Excel spreadsheet doesn't work for it.
It doesn't.
And
pencil.
It's you can just even if it's a beautiful computer animated thing, like there's something in my brain where I see CGI fire on a screen, and then I see real fire on a screen from and you know intuitively, and there's something about it that just hits different when you see that. But I also thought it was interesting. I know you're less of a superhero movie guy, but I think Marvel is in such an interesting place because there is an investing takeaway, which is that for a while, Marvel movies were essentially an exchange traded fund, which is we can put just about anything on screen and it'll make $1 billion.
Right.
And now there's this huge reversal where people are like, you know what? I don't want to see actors in tennis balls in a box in Atlanta, doing neatly put together for optionality purposes. And so now it's either a massive hit, it's Spider-Man making $2 billion, or a total flop. And Marvel's answer right now is all right, let's dust off the Avengers who can still make it for our next big swing. And maybe the X-Men, which we've been teasing since 2020. And I'm out on, by the way, I'm out on X-Men for now.
There's so much. Yeah. They've been building the expectations for X-Men for so long. It's gotta be countdown to letdown now on X-Men. Yeah. But that aside, no, I agree with you. It feels like it's so hit or miss right now. And Marvel is now, I'm sure at this point has decided it's just not risk. There's no value in exploring new characters. Let's just go back to what's worked, right? I mean, which is a shame because I think one of the reasons Avengers has worked so well is because it started out with Iron Man 1. You remember? And it's
I do remember.
It was such a well done movie, and it endeared you to that character, and it sort of slowly introduced you to this universe, right? I think in Iron Man 2, you saw Thor's hammer for the first time, and there's Easter eggs that's saying, oh, this is a bigger universe, Nick Cage, all this stuff, right?
Yeah.
And so what I don't like is that they're not taking the time, or they don't think there's value in sort of exploring one character, slowly building a universe, and then sort of throwing all this stuff on the screen and having all these characters. Now it's well, we know Avengers works. Now we know Spider-Man always works. Let's just keep redoing those every couple of years and we're probably good.
Yeah.
Which is a shame.
And I like Spider-Man. We haven't given Spider-Man
who doesn't like Spider-Man?
Let's shoehorn in another story for 40 minutes to say, even though this is personal, even though you're 30 years old, you've been watching Spider-Man since you're 6, keep holding on because something big is coming. It's the X-Men. All right. We've been doing this for 11 movies now. Let's end it there. Anything you want to plug?
No, man, I just want to say, hey, thanks for having me. And I love what you and Malcolm are doing with this show. I hope you guys keep it going. And I know it's going to be big. So
you're welcome back anytime, Matt. I appreciate it.
Thanks, Ricky.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.